Trying to manage all of the different steps required in qualifying for and getting approved for a home loan can be pretty daunting, if I'm going to be honest. Not to mention, with all the recent pandemic stuff that we've been going through, banks have really tightened their requirements as to what they'll allow people to qualify in order to lend to them. But even after saying that, it's still very possible to qualify for and get approved for a home loan. So today I'm taking you through all of the steps that you need to do in order to get prepared before you walk into the bank and kind of make a fool of yourself. These are the things that I wish I had known before I had walked in and asked for a home loan. Hey guys, if this is your first time here, let me introduce myself. My name is Bryce. I make videos here on YouTube talking about everything personal finance and real estate. I've been investing in real estate for about 4 years now, and so the reason that I say that is because I'm very familiar with the process. In the time that I've been investing in real estate, I've qualified for at least a dozen home loans, and so I've gone through the process enough times to be able to walk somebody else through it as well. While there are a few steps, I promise you it's not as daunting as it sounds, so stick with me through the rest of this video and I'll give you the step-by-step things that you need to do in order to prepare to qualify for your own mortgage. And also, if you could do me a favor, give me a thumbs up. That really makes a difference for me with the YouTube algorithm. This helps other people see this video and help them out as well. Okay, first and foremost, I think it's kind of important that we take a step back and just look at the overall economy. What are we kind of doing right now? How are things looking? Is now a good time to even purchase a home? Many of you know that back in 2006, 2007 timeframe, pretty much anybody with a pulse could qualify for a home loan, even if they had bad credit history, poor credit score, not even a job, you could still qualify for a home. After everything kind of came tumbling to the ground with 2008, 2009, banks started to change the way that they lended. They kind of tightened their belts and they said, okay, we're only going to lend to people who have cash reserves in the bank, who have good credit scores, who've got great job and work history. And so we saw a big difference in the number of people that were able to qualify for a home loan. And then gradually over the next 5 or 6 years, things started to slip a little bit. It wasn't as loose as it was before in 2006, 2007, but over time banks said, okay, well, instead of maybe 10% down, we're only gonna do 5% down. We used to need a 720 credit score, now we'll do a 680. Again, it was nowhere near as bad as it was before, but they started to loosen up because the economy was in good shape. And now fast forward to present day with the pandemic and everything that's going on, banks have started to kind of tighten their belt once again and say, okay, we're kind of uncertain with what's going to happen with the state of the economy, and so we only want to lend money to the least risky borrowers. So you can see there's kind of this cycle in real estate, and that's exactly how it is. So I don't say this to scare you or to mean that you can't qualify for a home loan. All I'm saying is that things right now are just a little bit tighter than they used to be, and so you may have to do additional steps that weren't required in the past. But one of the great things that this generation has that pretty much every other generation before it has never had is historically low interest rates. Interest rates right now are insane. The other day, in fact, I heard of someone getting a 2.65% interest rate on a 30-year fixed mortgage. That is unheard of. That is so incredibly low. So right now, you have the chance to take advantage of super low, historically low interest rates. Now let's dive into the actual steps into what it actually takes to get approved for a home loan. And the very first thing that the banks are going to want to look at is your income. Obviously, this is one of the most important steps with the whole process. The reason for that is because nobody's going to give you a loan if you don't have enough money to pay them back. And so they're going to do their due diligence. They're going to check your credit. They're going to check all these other things, but they absolutely want to check your income. They want to see that you have consistent, long-term, reliable income. And it's not enough to just say that you make enough money. You could say, oh, I make $50,000 a year, whatever it is. They're going to dive into pay stubs. They're going to want to look at your tax returns. They really just want to verify that you do have as much money as you're saying you do. The banks, they really prefer to see consistent income from something like a W-2 job. Now, that's not to say that if you're self-employed, you can't get a mortgage, but it's going to be quite a bit more difficult. They're going to want to see at least 2 years of consistent history from pay stubs and also from your tax returns. And there's going to be additional steps and hoops that they're going to make you jump through, unfortunately. So if you are self-employed, but you haven't you haven't been self-employed for at least 2 years and you don't have that work history, it may be in your best interest to just kind of wait a little bit, step back, and while you're waiting, work on your credit and work on building up your cash reserves for your down payment, which I'm going to talk about all these later on in the video, but that 2 years is a pretty strict requirement right now. The next thing you're going to want to do is get your credit in check. Before you even think about walking into a bank, if you don't have the slightest idea on what your credit looks like, you're going to want to check that out and just verify that everything's good and squared away, because that's the next thing that the bank is going to look at as soon as they look at your income. There's tons of services online that allow you to check your credit score for free. Personally, I like to use Credit Karma. Free service. They'll give you your credit score, but also more important than that, they'll also show you your credit history. The number obviously is important, but your number is composed of the history. So a lot of people just look at the number and say, okay, well, I guess that's what it is, but they don't go and look at the history. And the thing is, there can be errors and mistakes on your credit history. So I'd encourage you to go through and look at all the different items. For example, if you have a late payment for some reason on there and you've never had a late payment in your life, you can actually take these back to the companies, prove that you've never had a late payment, and they can remove that from your credit history, which obviously will bump up your credit score. Now, let's say you know your credit score already and you know you have good credit history. I would still say go and use this service, Credit Karma, because I've got A+ credit. We do a lot of real estate investing, and to do that, you have to have pretty decent credit. But the thing is, I use this service because I get notified each and every time my credit score goes up, my credit score goes down, or when someone requests my credit score. And I like this because I remember one time I was sitting on the couch and I was just scrolling through Instagram or something, and I got an email that was saying, hey, someone just checked your credit. And the thing was, I wasn't going through any new loans. I wasn't applying for a house or a car loan or anything like that. And I could instantly go and check my history and see who is requesting my credit score. So I think it's a really good service. Again, if you know your credit's good, I would still recommend using something like this. Now, to qualify for the home loan, obviously we want our credit score to be as high as possible, but typically speaking, banks are going to want to see a 680 or higher. And the reason for that is that just means that you're a less risky borrower. If you really want the best rates, the highest interest rates, and the lowest fees, you're going to want at least a 720, which for a lot of people is going to be difficult. And if you don't have a very good credit score, maybe now is the time to not qualify for a home loan. Because if, for example, if you were to just wait 1 year to work on your credit score, you would save tons of money in interest. Because if you have a poor credit score, the banks are going to charge you a higher interest rate and your mortgage is going to be higher, probably for the life of that loan. You could save hundreds of thousands of dollars in interest by just waiting 1 year to work on your credit score. And in many cases, it doesn't even take that long. You can clear up a lot of things pretty quickly in 2 to 3 months. If you still want to go down the route of qualifying for a mortgage, but your credit score isn't great, you may want to look into something called an FHA loan, which has lower lending requirements. I think the minimum for that is a 580 credit score. And the very last thing I want to touch on this topic is during this time, do not go out and get new credit cards or a new car loan, or even go purchase a bunch of furniture for your new house. If you're buying all these things and applying for all this credit, it could and probably will drop your credit score, and banks will see that as a red flag, saying, hey, they just applied for a mortgage and they applied for a car loan and they applied for a credit card. What is going on here? So they could disqualify you for the home loan. Wait until everything settles, all the dust settles, and your house is closed, the mortgage is finalized and everything, before you go and get another credit card or another car loan. The other thing that the bank is going to look at are your debts. And this is something called debt to income ratio, or your DTI. In a nutshell, this just means how much money per month do you owe to other people. This includes auto loans, this includes credit cards, this includes student loans, pretty much anything that you're required to pay on a monthly basis back to somebody else. But keep in mind, this only includes the minimum payment. So let's say you have a $3,000 balance on a credit card, but the minimum payment that you're required to pay is only $75 per month. That's what the bank is going to look at, not necessarily the $3,000. They'll take it into account and they'll say, hey, their credit limit is only $5,000 and they're using $3,000 of that $5,000. That's a little high. So they'll take it into account, but what they're really looking at is the monthly payment. So even if you have a $75 minimum monthly payment, but you're paying an additional $100 on it, they're not going to take that into effect. They're only going gonna look at the $75. This also does not include things like your utility bills or your cell phone bill or your groceries, for example. Even though these are things that you buy on a monthly basis, and chances are you're most likely going to spend money on groceries next month, it's not something that you technically have to pay. You don't owe money to anyone yet, and that's what the bank is looking at. Let's say you just theoretically you make $4,000 per month. Out of that $4,000, you've got a $300 per month auto loan. You've got a $75 per month credit card payment, and you're also paying $125 per month on your student loans. And also the new mortgage that you're going to be applying for, that's going to be taken into account as well. And let's say, just for easy numbers, that's going to be $1,000. That includes taxes, insurance, everything all together, $1,000. That means that all of your debts are $1,500 per month. If you take that $1,500, divide it by the $4,000 that you bring home, that means you have a 37% debt to income ratio. Most banks and lenders, for the most part, are looking for 43% or lower. If you can get it to even below 36%, that's great. That's kind of the sweet spot. That's the ideal spot to be. You'll get the best interest rates and the lowest fees. But I've heard banks for the FHA loans, the first time home buyer program, to be as high as 50% DTI. So if you run your numbers and you see that you're above that 43% or even above that 50%, I would say before you even go in to look to apply for a loan, you may consider paying things off or even selling things off. If you've got an expensive car loan and that pushes your DTI over that percentage range, maybe you should sell the car and potentially buy something cheaper for half or even a third of the cost so that you'll be able to qualify for the mortgage. Now that your income, your debt, and your credit are all in check, we want to see exactly how much house you can afford. Because listen, I promise you, I promise you, as soon as you go out shopping and you're ready to buy a house and actually pull the trigger, your budget is just gonna creep up ever so slightly. You're gonna see that, you know what, this is your budget, but if you just pay an additional $10,000 or $15,000 more for that house, then you can get the 2-car garage and you can get the fireplace in the living room. It happens every single time without fail, but I'm telling you, you have to stick to your guns. It is not worth it being house poor. There's nothing worse than being house poor and just stretching yourself so much further than you're actually comfortable with. The last thing that I would ever want you guys to be stressed or worried about is paying your mortgage. And you wanna know why? It's because I have been there. My very first house, my mortgage was $800 a month. And to me, that was a lot of money. And you know what? Sometimes I did stress about paying it. I would lay in bed at night and just think, how am I going to pay for this? How am I going to pay for my car payment and groceries and utilities and insurance? I mean, there's just a lot that you have to consider. So the worst thing that you can do is overextend yourself on the mortgage. The general rule of thumb is to pay absolutely no more than 30% of your take-home pay on your mortgage payment. Personally, I would even encourage you to stay lower than that. Try and stay to 25% if you can. That includes the mortgage and the insurance, taxes, everything all grouped together. My wife and I, our mortgage payment is only 12% of our monthly take-home pay. And the reason we do that is we want to be able to have some of the other niceties of life. We want to be able to have nicer cars. We want to be able to go on vacation and take trips and do all these other things. We don't want to just be tied to our house. And if our mortgage was 25 or 30 or 40% of our take-home pay, we wouldn't have any money to do all these other fun things that we want to have in life as well. The other thing is I really like the peace of mind in knowing that if I wanted to, I could literally go down the street and get a job at McDonald's. If everything goes belly up, I lose my job, I could literally get a job at McDonald's and pay our mortgage because it's so cheap. I guess at the end of the day, all I'm really saying is just kind of reel in what you want and just kind of realize, is this really something that we need right now? Do we need a 4th bedroom when a 3-bedroom house would really be a lot more affordable? Sometimes it can be hard to take that monthly payment and translate it into a number, for example, the number that you can pay for a house. So there's something that I like to use, and this is called the Homeowner's Affordability Calculator. It's by NerdWallet. It's a great website. Check it out. Basically, you can put in where you live, put in your down payment, interest rate, credit score, all these different factors, and it'll tell you that the price that you can spend on a house. Now, I went ahead and did this for my own numbers, and it's got a little slider on there. It'll say, you know, conservative to aggressive, and you can change that and adjust that for how aggressive or conservative you want to be on those numbers. In my experience, even the conservative slider was a little bit too aggressive. For example, it said that we could qualify for an $800,000 house. Personally, our house is half that, and so I think that it's just a little bit too aggressive. So I would say even dial it in just a little bit to the left of that conservative slider. I think that would be a little bit better. Now that you've got a good idea of how much your budget is and how much house you can actually afford, now we want to take into account your down payment. You may have gone shopping, you may have found the perfect house. It's ideal for you, it's great, the space, the yard is perfect, it's amazing, it is the perfect house. It's $400,000, but then you look and see that your down payment is gonna be $20,000, and you're like, oh, yikes, that's a lot of money. We don't have that much. So you may have to kind of reel it in a little bit depending on the loan program that you're going to be using and the amount of house that you're gonna be buying. So let's say, for example, that you're a veteran. You can qualify for something called a VA loan, which actually only requires 0% down. The only thing that you're gonna have to pay for are the closing costs. If you're not a veteran, you can qualify for an FHA loan, which I talked about a little bit previously. That only requires 3.5% down. So that's a great option if you're looking to purchase your very first home. The next loan program kind of above that is just a conventional standard loan, which is 5% down. And there's a lot of added benefits of this loan above the FHA loan. For example, you don't pay PMI for the life of the loan. You'll still pay it up to 20%. That's a whole other video. But if you can't afford that 5% for the conventional loan, that's probably a better way to go. And then obviously the best place to be is if you can put at least 20% down, because that completely drops off the PMI, which I just mentioned. This is private mortgage insurance. This is money that you essentially just throw out the window. Unfortunately, this is money that you pay to the lender because you don't have 20% equity in your home. When you don't have all that skin in the game, it makes you a more risky borrower. And so the bank wants you to put up additional collateral in case you ever quit paying or they have to foreclose on you. Hopefully that never happens. But if you're a good borrower, this is literally money that you're just throwing away. So if you do have 20% down, you can completely avoid that. I think this point isn't emphasized enough. Having the down payment is so crucial. You can have your income, your credit, your debt, everything is squared away and in check. But if you find the house and the bank is ready to loan to you, but you don't have enough money to buy the house, well, then you're out of luck. So make sure that you understand how much house you're buying, what loan program you're going to be using, and how much money you're going to be needing to put as the down payment. And also don't forget that there's going to be additional fees for closing costs. And there's also going to be just money that you're going to need set aside to move into the house. You would be amazed at all the things that you just don't realize that you're gonna have to buy. For example, if you have a yard now, you're gonna need a lawnmower, you're gonna need a weed whacker, you're gonna need trash bags, you're gonna need garbage cans, you're gonna need curtain rods, you're gonna need light bulbs, and just all these things add up really quickly. And so I'd encourage you to have even another $1,000 or $2,000 set aside just for all this stuff that you're gonna have to buy when you move into the house. Okay, if you have made it through all the rest of these steps, then you're to the final part where you need to go out and find a lender. This is somebody who's physically going to give you the money to pay for the house. Typically it's a bank or a credit union. You could go to a private broker, but in my experience, credit unions are usually the best. The reason for that is because they kind of have that small town feel. They're very friendly. They're willing to work with first-time home buyers and kind of hold your hand and walk you through the entire process. So this video is talking about the steps that you need to do to get ready for that, but they're gonna walk you through the steps with all the complicated paperwork and everything that you need to do with the inspection and all that kind of stuff with the title company. There's a lot to it. And so if you've never gone through it before, a credit union is a great way to do that. Not to mention, a credit union will usually give you the best rates and the lowest fees. Big banks have more overhead, they've got more employees, more things that they have to pay for. There's also more paperwork in my experience going through a big bank. And so in my opinion, if you can go through a credit union, the process is just a little bit easier. Okay, now I just want to leave you with one last tip. The next video that I want you to watch is this one, which is where I talk about something called house hacking. Now, the real estate investor inside of me, I'm kind of having a hard time making this video because I don't actually believe that you should go out and just buy a house. I personally believe that you should buy a duplex or a fourplex, live in one unit just for 1 year, for 1 whole year, and then after that you can move out and get the white picket fence, the backyard, the dog, all that kind of stuff. just postpone for 1 year. And the reason I say that is because if you do that, you can set yourself up financially for the rest of your life and you can live completely for free. So be sure to check out that video. I'll link it right here. Until next time, thanks so much for watching, guys. We'll see you next week.